Chime added 2 million accounts in Q4 while you spent 18 months evaluating core banking vendors. Still on month 14? By the end of this video, you'll understand exactly how much market share you're losing per day of delay and what the banks winning this race did differently. Here's what nobody tells you during the RFP process. Every day you spend comparing Fiserv to Jack Henry to FIS isn't just a day of internal deliberation. It's a day where neobanks are onboarding customers who will never walk into your branch. The average core banking modernization project takes between 18 and 36 months from initial evaluation to go live. During that same window, Chime added 5 million accounts. Varo grew deposits by $3.4 billion. SoFi processed over 200 million transactions. These aren't projections. This is what happened while community and regional banks ran vendor selection committees. The big three, Fiserv, Jack Henry, and FIS, power roughly 70% of U.S. banks. They're not the problem. Legacy thinking is the belief that you need perfect information before you move. The idea that if you just evaluate one more platform, attend one more demo, involve one more stakeholder, you'll somehow de-risk the decision. But you can't de-risk what's already happening. Market share doesn't wait for consensus. Institutions we work with share a common pattern. They start the modernization conversation focused on technology. Which core platform has better API documentation? Which vendor roadmap aligns with our 5-year plan? Which system integrates cleanest with our existing infrastructure? These are valid questions. But while you're answering them, your competitors aren't in discovery meetings. They're in market. The cost isn't the core system. It's every customer who opens a Chime account because your mobile app couldn't process a mobile deposit after 7 p.m. It's every small business that moves to Brex because your commercial lending process still requires a branch appointment and a 4-week turnaround. It's every Gen Z customer you'll never acquire because their first banking experience was already frictionless. And it wasn't with you. Here's the part that should terrify you. Neobanks don't just move faster because they have newer technology. They move faster because they're not afraid of imperfect launches. Chime's first product had gaps. So did Cash App. So did every digital-first platform you now consider a competitive threat. The difference is they shipped. They learned in public. They iterated in weeks, not quarters. And while you were waiting for vendor alignment, they built brand loyalty with 12 million Americans who will never consider a traditional bank their primary institution. Let me tell you about a moment that changed everything for one regional bank we work with. Robert Mitchell had spent 19 months leading a core banking evaluation, vintage cufflinks from his grandfather, the man who founded the bank in 1962, a constant reminder of legacy and responsibility. The committee had narrowed it down to 2 finalists. They were weeks away from a decision. Then Marcus Chen walked into his office with a tablet showing real-time data. Not a projection. Not a model. Actual customer acquisition numbers. Marcus pulled up a dashboard. Chime had just reported Q4 earnings. 2 million net new accounts in 3 months. Marcus scrolled to another screen. Robert's bank, in that same quarter, added 483 checking accounts. Total, across 12 branches, 6 digital channels. A marketing budget that would make most community banks envious. 483 accounts. Marcus asked one question. How many accounts did you lose while evaluating these platforms? Robert didn't have the number memorized, but he knew it was higher than 483. Account closures don't make it into board presentations the way new customer stats do. But they're happening. Every week, customers leaving for platforms that don't require appointments, or bankers, hours, or 3 forms of ID to open a savings account. That was the moment. Not when the RFP scores came back. Not when the vendor demos impressed the IT team. The moment Robert realized the evaluation itself had become the obstacle. They chose a vendor within 2 weeks. Not because one platform was objectively perfect, but because 6 more months of deliberation meant 6 more months of market share they'd never recover. Here's what happened next. They implemented Fiserv's modern core in phases. Not a rip and replace. Not a big bang launch. They ran parallel systems for 4 months. Migrated digital-first customers initially, then scaled. Within 7 months of go-live, mobile deposit limits increased, processing times dropped from 72 hours to under 12, and API connections enabled partnerships that weren't possible on the legacy infrastructure. They integrated a modern loan origination system, Abrigo, which cut commercial lending turnaround from 4 weeks to 9 days. Applications that used to require branch visits and paper forms became fully digital workflows. But here's the metric that mattered most. Customer acquisition didn't just stabilize, it reversed. In the first year post-modernization, they added 4,200 net new accounts. Not Chime numbers. But compared to 483, the trajectory changed. And more importantly, the customers they acquired were digital native, higher engagement, and significantly younger than their legacy base. They stopped losing the battle before it became unwinnable. Marcus told Robert something during that first meeting that stuck. Every day you delay is a day your competitors don't. The neobanks aren't waiting. The fintechs aren't pausing for stakeholder alignment. And the customers you're trying to serve? They're making decisions right now about where to bank for the next decade. You don't get a second chance to be their first digital experience. This isn't about picking the perfect vendor. Fiserv, Jack Henry, FIS. They all have strengths. They all have limitations. Institutions we work with succeed not because they chose flawlessly, but because they chose decisively. They recognize that speed to market beats perfection in analysis. They understood that modern core infrastructure isn't the finish line, it's the starting block. Every API connection, every digital payment rail, every integration that reduces friction, those are the advantages you build after you modernize, not before. So here's the one thing you can do this week. Pull your current evaluation timeline. Write down the actual decision date, not the aspirational one, the real one. Then calculate how many accounts Chime will add during that same window. Use their Q4 number, 2 million in 90 days. Do the math for your timeline. That's not a scare tactic. That's the market reality you're competing against. If that number feels uncomfortable, good. It should, because the window to act is open right now. But not for long. The customers leaving traditional banking aren't coming back once they experience frictionless digital. They're not waiting for your modernization project to finish. They're choosing their primary financial institution today, and every week you spend comparing vendor roadmaps is a week you're not in that conversation. The window is open, but not for long.